Well, in the big picture, and I'm talking about the next 5 to 10 years, we think our level of inflation is going to be higher. That 2% is a pipe dream. I mean, we're probably, it may not mean you go back to the late 70s, but what it does mean is that when you get these periods when they lower rates, and this could be an Arthur Burns kind of period like the 70s, where they should not be lowering rates with full employment, a lot of things going on. And they're probably late on rolling if we're really going into recession. But now they become political, which is what they were in the 70s, by the way, until Volcker came along. And he basically told President Reagan, hey, I'm not doing what you want. And so we're back into this mode again. And I think by lowering rates, and I mentioned this, I know I remember 4 months ago when I interviewed with you, I mentioned that you're probably going to get a chance. Rates going to go down somewhere in the next 2 or 3 quarters. And if they do, you're going to get a chance to sell those long bonds. You need to sell them. Don't get caught up in this idea that we're going back to a 0.5% or 1% interest rate. And oh, by the way, if we do, this market's down 50%. I don't think either one of those are going to happen. But the main point is that if you get a chance to sell this bond, you should sell them because there's really nothing there for it. If you think about a bond, like a 10-year bond, it's maybe a 1.2 over inflation right now. And that'll be a small period of time, we think. We think the way this government's run, the way we're printing, the way things are going, the only way out of this has to be you print it out. And eventually you can't loan long bonds in that situation. But I will tell you, Wall Street keeps selling them and people keep buying them. But from a Fed standpoint, I mean, you'd have to think, hey, this thing's a real mess. Look at the new bill they passed. $5 trillion debt loss. It moved it up. So nobody's worried about the debt limit right now. And then they go in a situation where neither party, anywhere, even state and local, nobody's worried about balancing budgets. Spend it, raise it, borrow it, spend it. And there's not much of a way out of that. I mean, there's nothing you could cut because some of the things you cut, you're immediately out of office. And so, to me, what happens is just keep on doing the same things. What that means, though, in the long run, if you're going to own some bonds, you better own some gold right beside it, I think, if that's what you have to do. But if a person says, I'm going to own a lot of bonds more than 5 years out, 10, 15, 20, 30, I really think they need to rethink that about where the country is today. What they can do with inflation is what Volcker did, which is you move the rates up so high that you're in a recession and you slow everybody down because the game's up. That's what he did. He pushed them up to, you could get just under 15% on a 30-year U.S. Treasury bond. Well, and that was 3 or 4 points over inflation at the time. That was the perfect investment at the time. And yet, nobody would buy it. You think about a U.S. Treasury, they can't call it away from you. It's not like a normal bond after 10 years. So you could have made a 30-year investment that would have beat every stock market investment out there. But individuals, no, I'm not going to buy that because I can buy a 90-day CD that'll give me another point higher than that. That's how people think. We do mostly bottom up on the investment side as far as finding things. But I will say this, 4 months ago, we were coming off that low and we were rallying up, and typical, everybody been trained to buy the dip. And so it worked again for them. But we were expensive by the time we got to June, but now we're real expensive. Now, what does that mean? That means you're selling at 23 times future S&P earnings, not past, and 26 or 27 times trailing 12 months. And under any circumstance you want to look at that, S&P 500 dividend, for example, is only one other time. There's only been 2 times when the S&P dividend was 1.2%, which is virtually nothing. And so when you get all this, you put all those things together, there's a lot of things going on, by the way. You look at delinquencies rising, you look at home prices are stuck, and you can see those little signs out there. You could see them before, but now I think they're having a little bit more impact. But I just think from an economic standpoint, you'd have to say we're flatlining at the very, very best. But that's sort of how we see it right now. The point being is that nothing really changes in people's emotions. All this period of time I've been in the marketplace, it's always the same. At lows and at highs. At lows, they're so distraught, they want to buy anything, which is obviously odd if you're really in there to make money. And at highs in the market, they don't want to sell anything. Because if they sell it, they're afraid, it's going to go higher. And usually it would if you sell a little bit. But the emotional part of it's not a lot different. I would say AI, to me, is sort of like the build out of the internet was in 98, 99, early 2000. They overbuilt it. And then 2 years later, everybody had to eat the CapEx and realize that, hey, we're not making any money here. And I think the same thing's happening in AI. It doesn't mean that AI won't do well. It just means that too many people ate the fruit. And so then some of them get sick. I think that's where we are, but it's not a lot different than a lot of markets. They're very similar in terms of greed and fear, I'll put it that way. I do think the immigration situation's having some impact because it makes the rate look kind of okay or maybe different. But if you look at jobs in general, though, they're coming off. I mean, we keep revising and that sort of thing, but we're certainly not in a move today that would make you think we're in some sort of robust move in this economy, for sure. When I think about a recession, I think about when the average person gets hit, pretty hard. Now, I don't know what the Fed would do about that in that case, and maybe they do another one of these overkills where they push so much money in that ruins everything again. But hopefully they'll realize this time around that if they do that, in the long run, it's going to be tough. But yeah, it wouldn't hurt to have a recession, really. We've got so much fluff in the system, super leverage in the system right now. It wouldn't hurt to clean it up a little bit. Well, a number of years ago, when you went to zero commissions, there's two things happened. You went to zero commissions, and then you changed from eighths, quarters, and half-point spreads to like 1 penny. So if you think about that, if I'm a little trader, now I've got a little machine here where, I can make a couple $100 on a trade or lose a couple hundred in that matter too. But so what's happened is, especially with people under 40, they really think they've found some sort of holy grail, and it never ends well for them. The thing that works for true investment is to own a producing asset for a long time. That's how you make money. And for these investors that are buying all these daily options and all sorts of trades and all the cryptos and all that sort of thing, when those things break down, they typically take a lot of people with them. And I suspect that will happen again somewhere. If you open up at the Ford's 400 every year, you're never going to see anybody that says, hey, I made a lot of money trading the index every day or on crypto. Now, that's my point, is that most of those people on there are own real estate companies. Some of them are in finance too, but the main point is that individuals are usually the last group to get on the train and the last group, unfortunately, to get off, because I've seen this too many times. But we'll see. I mean, individuals today, if you talk to them about selling part of their Apple or part of their NVIDIA or something like that, I mean, they're not going to do it. You might as well, I'll take your firstborn child because they've made a lot of money and they don't want to listen to you. That's fine. It's their money. Do what they want to do. It's interesting. You say late 90s, like particularly 99 and early 2000s, there's about 2 years there where everybody became a day trader and they were quitting their jobs and they were saying, this money is too easy to make. I'm pretty much set for life. I work 2 hours in the morning and then I'm gone. Everything's fine. Well, fast forward 3 years later, and they're all gone. What happens to that is if you have some really poor times and it goes the other way on you, they don't really have enough money to really stand hard times. And so a lot of them just lose it all. You can see what happens, but I've seen that before. Yeah. Well, you have to look at what your situation is. If you're over 60 or over 70 or so, you're in a different situation than somebody that's 30 years old. Because 30, you're going to continually put more money in a 401k. You're going to put more money in the market in your personal account. But most people in their 65, 75, 80, they have all the money they're going to have. That doesn't mean there's not a lot of it, but they're in a different situation that they need to keep enough liquidity so that they can have some peace of mind under any circumstance. This is where I come from. And you have to think about what's right for you. I'll give you an example. Let's say the S&P's up, 10.5 for the year, 10, 11 almost. And you have an account, which we have some like this, that are up 8%, but they have 50% in treasuries. Which one of those would make you feel more comfortable? The one that's fully in every minute, every day, and has no buffer, or the one that's doing okay? It's not some sort of race here, but you've always got some safety valve. And the main thing we do is we look at companies, and I'll tell you, it's just not there. If we had a lot of cheap companies, we would buy them, but we find some good things. I mean, some of the new companies we found in the last 3 months or so, if you take everything they have to spend, capital expenditures, debt, everything, and the cash is left over, their free cash flows are 9, 10, 11% 4%, which is really good. But see, there's not many of those. That's the problem. And so right now, I think when you ask a question, what's right for you? Here's what's right for you. If I come in tomorrow and let's just say, forget about what happens and I'll compress it. Say it's a 3, but I'm going to compress it to one day. And your portfolio is down 35 or 40%. Dollar amount, think about it. If that really unwinds you and you can't deal with that, if you think if that really happened, I don't know what I would do, or I'd be going crazy or whatever. Ask yourself that question. So if you don't have that staying power, then you need to raise some cash and have some liquidity, because you're playing a fool's game in that every so often you have a major sell-off and you'll have another one. And so if you're not ready for it, then, it doesn't work. And I'm not doom and gloom here. I'm just trying to tell you, you have to manage your risk. That's the key to investing. You have to manage risk. I mean, that's how you think about liquidity. And I see it today. A lot of people, 70, 75, 80 years old, I'm like, you're not even counting the fact you might get sick. There's all kinds of things. See, we're fiduciaries. So if somebody comes to us and says, hey, I got a lot of money, but I'm 80 years old, but it's 90% in the market, we won't take that account. I can't make a case for that person. If they're 25, I can.